Hi, folks. Dan Bird here with the Daily Scan for Thursday, January 9th. The market is closed today, so I just wanted to tie up a few loose ends. This probably won't be a very long one, hopefully today. So the first, of course, I'm not a financial planner or advisor, so anything I say is meant for educational purposes only, not for trading or investing, and I do not recommend when to sell or buy or what stocks to sell or buy. So keep that in mind. The first thing I want to do, because there were a few questions about a number of different things, the first thing I want to talk about is something I said yesterday about, I talked about what markets typically do, that there's a markdown period, a markup period, an accumulation period, and a distribution period. And this is back in 2021, which we looked at also using the relative rotation graphs, which I'm going to show again tonight. But this is the distribution phase right here, the end of 2021. And you can see that the market was making new highs all along this period right here. And then it went sideways, tried to make another one, didn't quite, then broke out right there. And everyone thought it was off to the races. That was in December. And this was the time when growth was underperforming value. So Wall Street was setting up for a long decline. And one of the things I mentioned is once that decline begins, and you can see right here, all the moving averages cross the 50-day right there. So that was the warning, the biggest warning sign to get out right there. This is a daily chart. But what I said was oftentimes it'll go down and then it will rally and come back up. And it will make people believe that this little downtrend is over, that we're going to continue that uptrend that lasted all the way through 2021. Actually began after COVID in 2020. So a year and a half worth that this was going to resume again, but it never made it above the 50-day. And then it went down lower. So there's a lower low and a lower high. And then it tried to rally again. And now everyone thought for sure, now it's above the 50-day moving average, we're sure going back to the highs, but we didn't. And then it went down again, made another lower low, tried to rally again, couldn't even get above the 50, went a lower again in June. Everyone thought that was the end and the market would start to rally. And then we had the famous Jackson Hole speech right here in August and sent the market lower one more time down to October, which was the low, the beginning of this current bull market that we've been in for over 2 years now. So that was 2022. October of 22 was the beginning of this bull market. And then it finally broke out above all the moving averages, including the 200 right there, and it continued to go higher. But this is what I mean when markets have been going up for so long, 2 years in a row, more than 20% gains. By the way, the market has never had gains in the year after 2 consecutive 20% gains. So if it goes up again and makes another 20%, that not only will be historically unique, it will be very odd if that were to happen. So keep that in mind as well. But this is what a cyclical bear market looks like. Lower lows, lower highs. That defines a downtrend. So those are the kind of things you want to watch whenever things get started. And usually when they get started, people will feel like that might be the end when it goes below the 200. Usually there's a bounce back higher. So you can wait for that to get out if you want to. But this was the first signal right there to get out. Now, if we look at this on a weekly chart, it's also even more interesting. On a weekly chart, what we see is the ADX, which I covered last week. For anybody that's interested, go back to the Technical Tuesday for last week. I talked about the ADX line. So when the red crosses the green right here, which is basically January 3rd. So remember, the week before, market was hitting all-time highs. The very next week gave the signal that the market was starting to go lower. There were other signals too that I talked about then. And the MACD, the momentum was already moving down. So that was your signal right there. And it stayed that way all the way to over here. It stayed that way until January of 23. So even though the actual bottom was in October, the ADX was telling you that the selling was not over, that it wasn't really safe to get back in until it went above all these moving averages right here, and the green line went above the red. So that's the way I explained how to use that, the ADX, a couple of weeks ago. So that's a great way to illustrate it. You can also see the MACD line went below zero right there, so confirming a downtrend, and went above zero right there, at basically the same time that these things happened. So these are the things that we watch for if the market does start to sell off. Hopefully everyone will move to cash when that happens, or before, and you'll have cash to deploy once the market does hit a bottom. And there are things to watch, lots of things that I will talk about what happens when the market does hit a bottom and how we can tell when that happens. One of them is on the charts page under Best Bottom Finder. So this right here is one of the things that we'll show you. And you can see right now, we are in the range right now of a bottom perhaps forming. So this many stocks, there's 26% of the S&P 500 is below their 50-day moving average, and 55% is below the 200-day moving average. So that's pretty significant. This actually might cause a rally here soon. So we'll see. If it doesn't, this could go even lower than that. But we'll continue to watch that because this will tell us when the bottoms are in. So that's one thing I wanted to cover. The other thing that somebody asked about was, how can I create those relative rotation graphs like I showed yesterday? So first I'm going to log out. This is my stock charts screen. I'm going to log out. So if you don't have a subscription, this is what it will look like. If you go to the charts and tools tab right up here and go down to RRG charts, relative rotation charts, and that will bring up the relative rotation graphs like I showed you yesterday. There's a couple of things you can do, but not too much. It gives you a few indexes, but it doesn't allow you to add anything of your own. So it has the NASDAQ, it has the Dow Jones, the S&P, all of those are right there. And you can move the indicator back a little bit. You can go back, in this case, to February, so about a year, but you can't go any further than that. And you can watch the indexes to see what they're doing, but you can't add any of your own tickers in there like I did yesterday. So now I'm going to log in and we'll take a look at what I showed you yesterday. And I'm going to tie up a loose end on what I didn't get to. I meant to, but I didn't. So we'll go to the RRG tab again, just like I showed you before. And now we have the benchmark is the S&P. I'm going to change this to daily. I'm going to change the range to 5 years. I'm going to change the group to sectors. And then I'm going to remove all but the aggressive and defensive sectors. So remove materials, energy, financials, industrials. Of course, you could leave them in if you wanted to. Here is healthcare. So these are the 6. XLY, XLK, and XLC are the aggressive. XLP, staples, real estate, and utilities are the defensive sectors. And then I'm going to add a couple of symbols. I'm going to add the NASDAQ 100 into this list, and I'm going to add the Russell 2000. So this is how you would do this. So now I have those in there, and I'm going to save. When I save, it will take all that. So they're the ones that I was showing you. So if we go back again to December of 21, if you'll remember, what I was showing was in December, November, December, you can see all the defensive sectors, even though the market was hitting all-time highs, were moving over into the leading area, and the aggressive sectors were all moving down to the lower left, the lagging sector. And as we moved into 22, which is when the bear market started, and if you remember on that chart, January 3rd, right there, is what the ADX line showed was the time when you should get out. And what this is showing is that all of the aggressive sectors with technology right down here in the weakening, but all the other ones here are in blue. But as we continue to move to the right, you'll see they don't ever move into the leading side. They continue over there on the left and they move down. And now we will see all of as we move further into 22, you can see right there, the defensive sectors are up there and leading. And then they came back again. So right there, you got real estate, utilities, and staples. And then Russell 2000 is starting to decline. Now, what I didn't show yesterday is what it looks like right now. So let's keep that in mind. And we'll go over here and look at December 24. So in December of 24, you can see the defensive sectors are now down here in the lagging area. So that's good news. The aggressive sectors are all in the leading area. So that's good news. That implies that we're going to get a rally and that the market may continue higher. So this is December 16th, middle of December. Continue through December. We get up to the Santa rally started on the 24th. That's right there. And then we move into January. And now you can see that the aggressive sectors are starting to decline, except for technology is still hanging in there. But as we move right now, we're on January 2nd. There's January 3rd. Notice the defensive sectors on the left-hand side, how they're beginning to move. There's January 6th. Now we're into this week. January 6th right there. January 7th. And January 8th was yesterday. So that's what we look like right now. Notice all of the aggressive sectors are all, I'll actually put an arrow on it, make it more obvious. So they are all heading over here into the lagging quadrant, and the defensive sectors are now starting to move over into the leading quadrant. So this is something to keep an eye on. If this continues next week is going to be a very bumpy ride, but this could be setting up for a year similar to 2022 if this continues. So this is the one thing that I left out yesterday, and I just wanted to touch on that. One other thing that I meant to show yesterday is for Bitcoin, I created a correlation with the TQQ. TQQQ is the 3X NASDAQ 100 ETF. So if the NASDAQ moves up by 10%, then it moves up by 30%. And I talked about this yesterday as well. But if that's a great way to leverage if you're sure that the market is going up, but it also can go down by 30% or 3X as well. But notice what it's doing with Bitcoin. So this is a 10-year chart all the way back to 2015. You can see back then, and TQQ started here in 2015, but you can see Bitcoin and TQQ. If it's down here at the bottom, that means it is inversely correlated, or it is not correlated. So when Bitcoin goes up, the NASDAQ could go down. When Bitcoin goes down, the NASDAQ could go up. And that continued as we went into 2017. There was still inverse correlation, or not as much correlation going into 18 and 19. It's starting to improve, starting to become more and more correlated. And notice what happens now right after COVID, which is right there. And Bitcoin continues to go higher, but look at the correlation with the TQQ. So right in through here, just the last couple of years, and the last 2 years in particular, which have all been a bull market. So the last few years, Bitcoin and the 3X NASDAQ 100 are extremely correlated. What that means is if the market crashes, then Bitcoin likely will crash right along with it because they are correlated. So just wanted to point that out. That chart is on the charts page. Down here where there's a bunch of other Bitcoin charts. So you can see that right there, Bitcoin correlation. There's also a correlation with gold, Bitcoin gold, the TQQ, and MicroStrategy, which is now the largest holder of Bitcoin. And again, you can see how correlated MicroStrategy is to Bitcoin. It basically just follows right along Bitcoin. Here's the TQQ that I talked about before. This is a shorter time frame, so it's zoomed in a little bit. It's actually a daily chart instead of a weekly. And then gold actually is not really that correlated with Bitcoin. It oftentimes is inversely correlated. So that's just something that's interesting. It's also there on the website. So the last thing I want to talk about is, and I talked about this, mentioned it before, but for subscribers to the website under the portfolios page, I have tax loss harvesting. These are stocks that have sold off the whole year last year. People will sell them at the end to take their losses, and then a lot of times buy them back in the beginning of the year. I bought a few of these, and some of them just within a week have gone up 10, 5%, 9%. These are meant for short-term trades. There are dividend stocks down here. So there's a list of dividend aristocrats and what those are. It actually has a link to dividend aristocrats. So these are stocks that have increased their dividend every year for 25 years. And if they fail to do that, they drop out of the list and it takes them 25 years to get back in. So these are very strong dividend stocks. And then also the Vanguard high yield dividend stocks also. And I grouped these by the best 15 up here, and these down here is the best 18. So you can look at those lists. But what I just completed today is the market timing strategy, which was a little confusing before. Here's the instructions. So anybody that's interested, I encourage you to read through that. But essentially what I did was just focused on the total market index as the trend following component. And when that starts to turn up, and we use a weekly to determine that. So if we look at the weekly right here, the one thing I added in is the date that it went bullish. So you can see here it went bullish on November 2nd of 23. So more than a year now, this has been bullish. So if you were to have been able to get in on that date, we'll actually look at the chart right here. That's right back here. So it went bullish right there. I actually put an arrow right on the chart so you know it, and then it stayed bullish all the way through till today, and it has not changed. So for over a year, you could capture long-term capital gains as a result, but this is just the indicator to determine what you want to do. If you decided that you wanted to go with the TQQ, triple leveraged 3X NASDAQ 100, then you could have bought that one right there and ridden that one up as well all the way through. Now, this is just a daily chart, so it's just going to show you what it looks like today, but it looks very similar. It would have stayed bullish all through that whole period. So the total market index is the key to focus on, and then you choose whatever long or inverse ETFs that you want. Now, when this goes bearish at some point, and at some point it will, you can see on the daily chart, it actually went to cash right here in December. But the daily chart is just meant for determining entries if you get into the middle of a long-term uptrend. So if you wanted to join and you didn't catch it in November of 2023, then you could just watch the daily chart to determine when to get in. So there are the entry points. There are no arrows for exits on this because that is up to each individual of how they want to manage their portfolio. But it's whenever this weekly one goes short, when this shows short up here, then we move into the inverse ETFs, and you can see they've already started to move. So the inverse ETFs actually gave a signal right here, right in this period, which is only about a week ago. It hasn't gone above 0 up here yet, and it's still below the cloud. So it's not really proven itself that this uptrend will continue. But once it does, and it gives a signal, then we can make money even as the market falls. So if the market falls like it did in 22, then this is the way you can play it. But that's what the market timing strategy is meant to do. The whole thing is explained right on here, and it allows you to, with very little effort, get into a long-term trend and just stay with it, just using one ETF, or you can do the SPY, you can do the S&P and the NASDAQ, or the IWM, which is the Russell, or just pick one. NASDAQ is usually the one that moves the most, but each person has their own strategy. So that's why I listed them out like this, so you know what they are, but this is the one to key off of to determine what the direction of the market is, or the trend. It's for trend followers. Okay, that's it for today. Thanks everyone for watching. Market's not open today. Tomorrow is the jobs number. Keep an eye on that at 8:30 in the morning. And good luck and good trading. Take care.